Hi, in this video, we will solve a complete comprehensive example to demonstrate the fourth method of adjustment of capital at the time of retirement of partner. The fourth method is when the retiring partner is to be paid through amount brought in by the remaining partners in a manner to make their capitals proportionate to their new profit sharing ratio. So let's go on to the example sum. Example sum. Balance sheet of X, Y, and Z who shared profits in the ratio of 5:3:2 as on 31st March 2019 was as follows. To the left of the screen, we have the balance sheet given. On the right, additional information. Y retired on 1st April 2019, and it was agreed that first point, goodwill of the firm is valued at rupees 1,12,500 and Y share of it be adjusted into the capital accounts of X and Z who are going to share future profits in the ratio of 3:2. Second point, fixed assets be appreciated by 20%. Third point, stock to be reduced to rupees 75,000. The fourth point, Y is to be paid through amount brought in by X and Z so as to make the capitals proportionate to their new profit sharing ratio. We are asked to prepare the revaluation account, the partners' capital accounts, and the balance sheet of the new firm. So the point 4, which says Y is to be paid through amount brought in by X and Z so as to make their capitals proportionate to their new profit sharing ratio. This tells us that it's a fourth method of adjustment of capital at the time of retirement of partner. So we'll begin with the revaluation account, go on to the partner's capital accounts, and then the balance sheet. We'll do the working notes after the balance sheet. Solution. Revaluation account. Left side debit side and right side credit side. Particulars. Rupees. Particulars. Rupees. Point 1 is about the goodwill treatment. The second point, fixed assets be appreciated by 20%. So we need to increase the value of fixed assets by 20%. By fixed assets account, ₹37,500. Third point, stock be reduced to ₹75,000. So to stock account, 82,500 book value needs to be reduced to ₹75,000. So the amount of reduction is ₹7,500. The fourth point is about the adjustment of capitals. All entries are done. We will balance the revaluation account. Greater total 37,500 on both sides. There's a gain on revaluation. To gain on revaluation, transferred to partners' capital accounts. We have partner X, partner Y, and partner Z. The total gain on revaluation, 37,500 minus 7,500 rupees, it's 30,000 rupees. For X, it needs to be divided in OPSR 5:3:2. For X, it's 15,000 rupees. In the case of Y, it's 9,000 rupees. And in the case of Z, it's 6,000 rupees. So this is a revaluation account. Next, we'll prepare the partners' capital accounts. Partners' capital accounts. Left side debit side, right side credit side. We have particulars, partner X, partner Y, partner Z, and on the credit side again, particulars, partner X, partner Y, and partner Z. We'll begin by bringing down the balance of the capital accounts. By balance brought down, 1,65,000 for partner X, 84,000 rupees for partner Y, and 66,000 rupees for partner Z. We'll transfer the gain on revaluation by revaluation account. As per the revaluation account, it was 15,000 rupees in the case of X, 9,000 rupees in the case of Y, and 6,000 rupees in the case of partner Z. We'll deal with the reserves. There's a workman compensation reserve of 22,500 rupees in the liability side of the balance sheet. There is no claim at all against this reserve, so we'll distribute 22,500 rupees in the OPSR 5:3:2. So by workman compensation reserve account. In the case of X, 11,250 rupees. In the case of Y, 6,750 rupees. And in the case of Z, it's 4,500 rupees. There are no accumulated profits, no accumulated losses or fictitious assets. We'll deal with goodwill. There is no existing goodwill. We'll treat the first point where the goodwill of the firm is valued at rupees 1,12,500 and Y share of goodwill to be adjusted into the capital accounts of X and Z, who are going to share future profits in the ratio of 3:2. So let's do the working notes for this. So the working note 1 is for the treatment of goodwill. Firm's goodwill, as given in the point 1, it's rupees 1,12,500. OPSR between X, Y, and Z is 5:3:2. The partner who retires is Y. Further, the NPSR between X and Z is equal to, as per point 1, 3:2. So the firm's goodwill is 1,12,500. So Y's share of goodwill is equal to 1,12,500 rupees multiplied by 3 divided by 10. This is equal to 33,750 rupees. Let's find out the gain or sacrifice of partner X and partner Z. In the case of X, the old share is 5/10 minus the new share 3 divided by 5, There's a negative 1 by 10. X gains 1 by 10. For partner Z, old share 2 by 10 minus the new share 2 divided by 5 is equal to a negative 2 divided by 10, and Z gains 2 by 10. Hence the gaining ratio between partner X and partner Z is equal to 1 by 10 is to 2 by 10, or 1 is to 2. So let's pass the journal entries. We'll debit the gaining partners. X capital account debit. Z capital account debit. To the retiring partner Y capital account. Amount against partner Y is Y share of goodwill, 33,750 rupees. We need to divide this in gaining ratio. So in the case of X, it's 33,750 rupees multiplied by 1 by 3. And in the case of Y, it's 33,750 rupees multiplied by 2 by 3. So we get, in the case of X, 11,250 rupees, and in the case of Z, 22,500 rupees. So let's post this in the partners' capital accounts. By X capital accounts, 11,250 rupees. By Z capital account, 22,500 rupees. And on the debit side, to Y's capital account, under X we have 11,250, and under Z we have 22,500. Next, we've completed all the entries. We'll do the adjustment of capital as per point 4. We'll begin by paying off Y the amount which is due to him. The credit side is greater. The total of the credit side, 1,33,500 rupees. And the balancing figure which has to be paid is also 1,33,500 rupees. So to bank account, amount paid to partner Y, 1,33,500. We'll continue with the adjustment of capital. We'll put the partner's capital account in the first half of the screen. Working note 2 is adjustment of capitals. Step 1, we need to pay off retiring partner. This has been done. Step 2 is to calculate the adjusted capitals of continuing partners X and Z. In the case of X, the credit side total $1,91,250 minus the debit side total 11,250 rupees. The adjusted capital is 1,80,000 rupees. In the case of Z, the credit side total 76,500 rupees minus the debit side total 22,500 rupees is equal to 54,000 rupees. Step 3 is to get the total capital of the new firm. For this, we need to add up the adjusted capitals. 1,80,000 for X plus that of Z, 54,000 rupees. Plus, we need to add up the amount which is paid to the retiring partner, which is 1,33,500 rupees. So we get 3,67,500 rupees as the total capital of the new firm. Step 4 is to ascertain the new capitals of X and Z. For this, we need to take the total capital of the new firm, answer of step 3, which is rupees 3,67,500, and divide this in the NPSR of X and Z. So as per the problem, the NPSR of X and Z was 3:2. So in the case of partner X, we get rupees 2,20,500, and in the case of partner Z, we get rupees 1,47,000. The final step 5, comparing adjusted capital and new capitals. In the case of X, the adjusted capital was 1,80,000 rupees and the new capital was 2,20,000 rupees. So X has to bring in cash of rupees 40,500. And in the case of Z, the adjusted capital was 54,000 rupees, whereas the new capital is 1,47,000 rupees. So Z has to bring in 93,000 rupees. So let's post this in the partners' capital accounts by bank. X brings in 40,500 and Z brings in 93,000 rupees. Let's insert the new capitals, balance carried down. The new capitals in the case of X as per step 4, it's 2,20,500 rupees. And in the case of Z, it's 1,47,000 rupees. So if both sides tally, we know that our arithmetic is correct. Credit side total for partner X is 2,31,750. The debit side total is also 2,31,750 rupees. In the case of partner Z, credit side total was 1,69,500 rupees. And debit side total is also 1,69,500 rupees. So this is the partner's capital accounts. We'll go ahead with the balance sheet. Balance sheet as at 1st April 2019. On the left side, we have liabilities. Right side, assets. We'll begin with the liability side items, sundry creditors. No change in value, 39,750 rupees. Employees Provident Fund, again no change in value, 5,250 rupees. The workman compensation reserve has been distributed. We'll insert the capital accounts of the partners. We have X and partner Z. As per the capital accounts, balance carried down. In the case of X, 2,20,500, and in the case of Z, 1,47,000. $2,20,500 in the case of X and 1,47,000 in the case of partner Z. Total 3,67,500 rupees. Bank, the opening balance 15,000. We'll add the amount which is brought in by partner X, 40,500, and the partner Z brings in 93,000 plus 40,500 plus 93,000, and we'll deduct the amount which is paid to the retiring partner Y, which is 1,33,500 rupees. So we get back the minimum balance, which is 15,000 rupees. Debtors, there is no change in the value, 97,500 rupees. Stock, as per point 3, we reduce the value of stock to 75,000 rupees. Fixed assets, The original figure was 1,87,500. We increased the value by 37,500 rupees. So now the value of fixed assets is 2,25,000 rupees. All the items are done. We'll check if the balance sheet tallies. The liability side totals to 4,12,500. The asset side also totals to 4,12,500. So this is a balance sheet. I'll remove the split. We can view the full answer. So we began with the revaluation account. After that, we prepared the partners' capital accounts. And then the balance sheet. The first working note was for treatment of goodwill. The second working note was for the adjustment of capitals.